All right, it's a no change policy. There is no change in the repo rate, but there are many announcements which has been made by Reserve Bank of India governor. If you talk about the growth, yes, guidance has been raised upwards, keeping in mind the new series Q1 and Q2 are now nearing 7% with the Q1 of next financial year around 6.9%, Q2 at 7%. But more importantly, the inflation is going to hit 4% mark in the Q1 and Q2 as per the forecast given by the governor. But that is not what governor has announced. There are much more announcements which have been made for the banking sector. There are draft guidelines which are going to be issued on mis-selling, issue which has been raised several times now, recovery of loans, limiting liability of unauthorized transaction, and 25,000 rupees can be availed by a customer if at all any fraud has happened. To understand how will it impact the banking system, we have none other than Managing Director of State Bank of India, Mr. Rama Mohan Rao Amara. My first question to you is the announcements which has been made on the banking sector. I'll start with mis-selling of the loans.
Yeah. So good morning, Ankur, and thank you for inviting me to the show. As you are aware, this agenda has been engaging the attention of RBI for quite some time. There are various forums that are used to convey their concerns. And of course, the regulated entities also take several measures. It is directly under the oversight of the board and the various board committees which deal with the customer service. But the proposed measures, I mean, which we need to look at the fine print, what it entails, I think further bolster the confidence of the people. I think that the practices will be more aligned to the regulatory compliance. So I think we need to look at the fine print as to what is the further liability on the part of the bank that is envisaged. But in general, the banks are always aligned to reduce the mis-selling or minimize the mis-selling.
All right. I also want to understand now that the 25,000 kind of amount is fixed if such kind of fraud has happened. Overall, there will be an impact on the banking system per se of these announcements. What is your assessment on that front? And you think the banks were already preparing for these kind of announcements because Reserve Bank of India had been warning on them?
Sorry, Ankur, in between there is a connectivity issue. Can you repeat the question?
I was asking that this announcement has not come as a surprise. Why? Because Reserve Bank of India had been warning about such kind of activities which are there by banks, and they are watching. And now today, a kind of regulation has been brought in. I'm saying there will be an impact in the banking system per se of all these preparations. Were banks prepared for that? And particularly, there was a preparation which was made. And I'm asking particularly on amount being fixed for a customer fraud, which will be a huge ask.
I think RBI, to its credit, has been nudging the regulated entities. I mean, it is inviting the attention. There are various forums they use to convey the concerns, either directly with IBA or individual banks through the supervisory exams. Also, they do convey and they do comment on the adequacy of the controls. I think this is a view perhaps taken that there is a need for now a proper regulation, considering their experience and considering what they are seeing in the system as a whole. I think it is a right measure. Similar kind of measures are already in vogue, even outside India. I think it is a right measure, if you ask me.
Right. Mr. Balasubramanian, talk to us about your initial take with regard to how you're viewing the policy. You know, of course, it was largely in line with expectations, but anything that stood out for you in terms of the commentary?
No, I think, so we went into the policy looking at inflation sort of bottoming out, both with respect to a base effect and food inflation starting to edge up a little, although it is continued to stay benign. And like the RBI's forecast itself suggests, if you look at 9-month ahead inflation, for example, these forecasts are towards the 4% mark. And while we also see some disinflationary pressures from, possible lower China producer price index and higher capacity there. But we also see that industrial metal prices have started to sort of go up, probably because of supply issues for now, but we have to see if there's an element of demand there. And like the governor said, there's a new CPI series also coming up. And at the same time, if you look at growth, growth has continued to stay quite buoyant. And now there's an upside from the recently concluded discussions on the India-US trade deal. So therefore, we were going into the policy with expectation of a hold. And again, so transmission of the 125 basis points cuts is also happening. RBI has more clarity on fiscal and again the trade deal. And with even credit deposit ratios slightly elevated, I think the focus is more on the liquidity side, and that's where RBI has been proactive. And again, like the governor said this time, it continues to be proactive. It has been doing a lot of OMOs. So if you look at some of the numbers, for instance, in the last 13 months, RBI OMOs have accounted for more than 75 to 80% of the net G6 supply in those 13 months. And even if you look at the last couple of months, let's say just December and January, it's almost 1.5 to 1.6 times of the net G6 supply that has happened during the period that RBI OMOs have taken out. So that's a very strong force there. And understandably, the RBI is also focusing on regulation. So I think liquidity and regulation remains the key focus areas, while RBI continues to allow the transmission of the cuts that is already done in 2025.
Right, and regulations and liquidity indeed remains a focus area, at least for this policy. After last to last policy where 22 announcements were made, this policy is not limited to them. But I want to come to you, Mr. Rama Mohan Amara, on the liquidity front. Yes, the situation has been given that the surplus liquidity is there, but year end is coming and no particular announcement was made in the policy this time, unlike what happened in the December one. How do you take the liquidity situation and how governor is responding to them?
I think RBI has been very proactive in terms of liquidity management. They have been using various tools that are available to them, whether it is a long-dated VRR or otherwise, whether it is a dollar rupee buy-sell swaps, etc. And of course, the OMOs also. I think the last one has been very effective in terms of not only providing the liquidity to the system, but even actually sending a message on the yield side as well. So I think, as governor has said, they will continue to monitor the liquidity, and liquidity management is the top priority, because everybody knows only when the liquidity is robust, then the transmission will also be faster. So I think this will continue to engage their agenda.
And Mr. Amara, your take with regard to transmission itself, in terms of a timeline, could you give us a perspective on how much of it is already done and how quickly will it transmit fully?
In terms of loans, I think for most of the banks, large portion of the loans are already linked to external benchmarks. So to that extent, the transmission is instantaneous almost, barring maybe with a lag of a maximum 15 days. But on the deposit side, obviously, the transmission is slower for the obvious reasons, where there is intense competition for granular deposits. But it is not to say it's not happening. In fact, some of the results from the banks which have already announced quarterly results, they do indicate a NIM uptick as well. So I think the transmission will continue, because particularly on the outstanding deposit, if you see, it is much slower as compared to the latest deposit rates when we see.
Okay, thank you so much, Mr. Amara, for joining us. We'll let you go on that note. Let me go across. We also are joined in by Anubhuti Sahai of Standard Chartered, Basant Bafna of Mirae Asset, Sunil Mehta of PNB. Now, let me come to you first, Mr. Sahai. Give us a sense, Ms. Sahai, give us a sense of how much of this transmission, just carrying forward that question from Mr. Amara, give us a sense of how much of that transmission is likely already done, how much is still pending, and how best should this transmission play out?
I think if we look at the policy decision today, most of us was in line with expectation. And this whole emphasis on providing liquidity to an extent that there is sufficient allowance for short-term fluctuations, whether due to government cash balances or FX intervention, etc. That is extremely important for transmission. When we talk about transmission, there are two parts to it. One, what the banking sector does, and the second, what we see in the markets, which is money market as well as the bond market. And I think assurance that liquidity will be more than adequate is likely to keep the market rates contained, mostly on the money market side. It is also assuring for the bond market, but for the bond market, I think the bigger driver at this juncture would be the supply demand of bonds, and that remains very unfavorable. The key driver for bond yields, how much they can be contained from moving up, would be how many RBI OMOs are done during the year to ensure enough liquidity injection, as it would be the key balancing factor in making the supply demand far more balanced. So that would be the focus rather than just focusing on the banking sector.
Right. I want to come to you, Mr. Basant Bafna, for the reaction. Now the monetary policy statement has been released, and in that it has been clearly mentioned that Mr. Ram Singh has voted for accommodative stance in the policy. What is your take on the stance which has been kept neutral this time, and also the impact on bond yields you see due to the announcements which are made today?
So in terms of the stance itself, I think that provides the flexibility to RBI to act on both sides, depending on the prevailing liquidity conditions. Right now, what RBI has done is that it has taken several measures, durable as well as short-term in nature, to make sure that liquidity is in adequate surplus. And with that, what has happened is that overnight rates over the last 3-4 days have fallen below the repo rate as well as the SDF rate. So significantly lower, around close to 50 to 75 basis points lower than the SDF rate as well. With that, what has happened is that the money market yields begin to show a significant amount of carry attractiveness as compared to the prevailing overnight rates, and that has led to money market rates falling by close to 20 to 30 basis points. But having said that, even as money market rates have fallen, they still remain at significant highs as compared to, say, for example, March levels when liquidity was in significant amount of deficit. So from those levels, we are still looking at close to 50 to 60 basis points higher spreads as compared to the March levels. But in terms of the market reaction, I think there was an expectation perhaps on further liquidity measures, or perhaps quantum of OMOs perhaps to be specified during the sort of policy statement. Since that has not materialized, yields have been higher by close to 3 basis points as an immediate reaction to the policy.
Policy. We also have Mr. Sunil Mehta, former MD and CEO of PNB, joining us. Mr. Mehta, good morning and thanks for your time. Now, there is something that really stands out in this policy, something that's not happened earlier, is the sector-specific mention by the governor in terms of precious metals and tech, two sectors that stood out. How should one be reading in terms of what implications volatility here could have on the growth outlook going ahead?
Good morning, and I think all the policy declarations were in the line, and especially for the tech and the precious metal, the two sectors which the governor specifically mentioned. We have seen the volatility in the precious metal market during the last 1 year, and the growth were to the extent of 74% in silver, in gold, and more than 200% in silver. That has led to a lot of volatility in the market, and a dependence of this will reflecting on the various lending of the banking sector. So I think the measures which will be announced will definitely help in containment of the systemic risk which these volatilities may impact in the portfolios relating to these type of lendings. Another issue which the governor has specifically said about the tech sector, because the tech sector is the contributor into the maximum share by appreciation this time, because that is one sector which is supporting and making India as a digital first in the entire international economy. So that measure will support this sector also. And especially the emphasis on the remaining two, that is MSME limit to be raised from 10 lakh to 20 lakh. That will shows the intention of the governor to give a boost and the growth momentum to the MSME sector, and the new measures which will bring it about the KCC. So that KCC will be the focus, will benefit the farmers when it is more institutionalized and made customer friendly. I think these are the intentions of the government in giving the boost to the economy in the terms of growth.
Mr. Mehta, you've been a banker and therefore talk to us. Is the rate transmission challenge only because of the fact that we've had a bunched rate cut cycle that we've had and very quick in terms of the rate cut cycle? And in such a scenario, do you expect the transmission to happen or take maybe 3 months, 6 months? How much longer?
So I think as governor has already indicated in his speech, about 125 basis point cut into the repo rate, 1.05 has already been transmitted, and that is the assessment of the regulator. So the gap is only 20 basis point, which is yet to be pending for the transmission. So every bank has certain portfolios. Certain portfolios are linked to the benchmark rates. There the transmission happen immediately. But there are certain elements which are fixed loan rate. There the transmission do not happen because they are fixed for the tenure of their loan. And then there's certain portfolio where it is linked to the lending rates of the banks, and those lending rates keeps on changing. Maybe some banks announce it on a monthly basis, and that MCLR rates keep on changing after 1 month. So there is a lag between the transmission to do. So the 100% transmission may not happen because of the certain element of the fixed loan component, but 105 basis point has already happened, and remaining the part of it may be on a continuous thing may happen in the future. And as regards deposits, as Governor rightly said, it is a transmission was to the extent of 95 basis point. The reason is there is always a time lag. The way I said you about the fixed term loan, the same way there is a fixed term deposit. So once the deposit is contracted, there cannot be transmission at a lower or a higher, and that continues only till the maturities. It depends upon the portfolios of those FDRs when they mature. Only then the transmission will happen. So 100% transmission on both the sides may not be possible, but then there's a headroom available, especially in the area of the credit.
A question all like all right,
Yes,
Mr.
please.
Mehta, we'll leave it at that. But I want to come to you, Srijit, on the announcements which has been made in this policy and particularly on the growth and inflation guidance. Now, the new series is, of course, awaited, but keeping that in mind, specifically, Governor has mentioned, yes, CPI is going to inch more than 4% mark in Q1 and Q2 of the next financial year. Do you think that series has been kept in mind, or you think that situation might be different in the April policy?
So,
No,
the have been quite minor. It's just from the 4%, just under 4%, we've probably gone to just to 4 or just above 4% in the first half of next year. So I wouldn't say that's a big jump. And for the current quarter, we've probably gone up by around 20 to 30 basis points, which is where we were tracking as well. As far as the new series is concerned, what we have right now in terms of data is only the new weights. We don't have, obviously, the new index values and, as per the new definitions, the new basket, etc. But purely just based on the weights, if you were to just have an illustrative example, then I think we are probably looking at around 40 basis points of roughly higher inflation readings with respect to the old series. So for example, if you looked at the December CPI print, it could have been probably another 40-50 basis points higher if we apply the new weights. But that's a very basic exercise. So that's probably one thing that is playing on their mind, but I don't think that will be a major factor. And similarly, we also have the new GDP series coming out the end of the month. So that's also something that they would probably look at. And that's why probably they refrained from giving a full year forecast this time.
Okay, so that's on that because yes, of course, the series change is something that we are going to be watching out for as the base for both GDP as well as the CPI outlook. But Ms. Sahai, talk to us about the inflation outlook for FY26 overall and for Q4 as well as Q1 FY27. The inflation outlook, pardon me, has been raised very nominally, but for Q2 FY26, it's at 4.2% compared to the earlier indicated 4%. So quite the jump over there. Talk to us about how seriously should we be looking at this spike that's been given in the inflation outlook, and how much worse could it possibly get? Ms. Sahai, you'll have to unmute yourself, please.
Yeah. Am I audible now?
Yes, please. Go.
Yeah, so I think from the FY26, Q4 FY26, as well as H1 FY27 inflation upward revision, as you very rightly said, these are nominal revisions, but the key takeaway is that it moves close to the medium-term inflation target of 4%. If you look at the December MPC statement, there it was expected to remain below 4%. I think that is the biggest switch which is happening. Quantum of increase is small, but touching the psychological level of 4%, that becomes important. Having said that, when we are looking at fiscal year 27, I mean, fiscal year 26 is now a rear mirror view. So I don't think that will be the key driver. I think what matters a lot is how the FY27 inflation looks like. The governor, as per the old series, has given a projection of close to 4 to 4.1% for H1 FY27. But a simple application of, say, the new weights which have been released, that indicates that there is a possibility of a downside risk to our current inflation forecast of 4.1% for FY27 by 30 to 40 basis points. Of course, this is a very basic exercise. We need to see how the indices get recalculated because there is an expanded coverage, there are methodology changes, etc. But our sense is that as FY26 GDP CPI is likely to look higher versus the old series, there is also a risk that the FY27 forecasts are likely to be eventually revised lower when the new series are released. What we will watch out from the market impact perspective is what is the quantum of downward revision. If that opens up room for another rate cut, RBI might decide to exercise it, might not decide to exercise it. Our view is that the new series can open up another 25 basis points of rate cut possibility, but the compulsion to deliver or use any available space just doesn't exist given the growth story, given that pressure on INR to weaken, while temporarily it has abated, that is still likely to remain a theme for the rest of the calendar year.
Ms. Sahai, I'm curious to know, while there was precious little said with regard to the rupee and its slide, in terms of your opinion and in terms of whatever limitedly was said about, for example, forex reserves, what is it that you see in terms of a real risk with regard to the rupee, or is the worst behind us?
I think with this whole US-India trade deal announcement, we have clearly, seen FX market taking a big sigh of relief. The downside risk to the overall macro environment and this whole amount of pressure on rupee to be depreciating at a much faster than expected pace, that downside risk has been taken out. This removal of overhang of uncertainty is a clear positive, whether you're looking at it from a 2 months perspective or whether you're looking at it from a 12 months perspective. Now, in the near term, that is over next couple of months, our sense is with this positive development on the US-India trade deal announcement and positive seasonality, in March quarter, the trade deficit is narrowest for India. When we put these things together, we think there is room for further appreciation in rupee towards 89.50. So we do think that 90 levels are likely to be broken down. But for the year as a whole, say December 26 end, our forecast for rupee is still at 93. The reason being that positive seasonality and the positive impact on sentiment, etc., would start fading off. And what would come to the forefront and be the driver of rupee trajectory will be the capital flow story. The capital flow story will change a little bit, but with missing FDIs, our sense is that the pressure on rupee to be on the depreciation path is likely to remain, but not at the same pace as it was seen in the past few months.
Right. Of course, rupee is something which will be watched out for. Mr. Basant Bafna, one question which market will be asking now. Do you think in the near term, the rate cut cycle is over? Do you think there is further scope for Reserve Bank of India to cut rates, considering the inflation may be inching upwards of 4% in the next financial year?
So in the near term, perhaps due to the change in CPI series, there is a possibility that inflation inches higher. But then because of the base effects, 1 year ahead inflation, as Anubhuti alluded to, is expected to inch lower. And depending on the pace or the size of inflation inching lower, there is a possibility that that might open up policy space for RBI to reduce rates by another 25 basis points, but the bar for that is significantly higher. I think RBI would use absolute discretion to, and be very cautious to use that space.
Okay, and Mr. Shrijit, talk to us about what the outlook could be for the economy going ahead. There have been multiple mentions of the trade deal of precious metals, but the optimism around exports, around remittances, around forex, that continues to remain high. At a very broad macro level, do you believe that we're headed towards the right direction now that the trade deals have also been signed?
Yeah, so see, we have a nominal GDP of around 8% this year, although real GDP is quite strong. And we were on track for that to sort of bounce back a bit. So the rural economy was doing better than the urban side, and the urban side should be catching up, like the governor said. On the external front, which is where most of the major challenges were, I think the trade deal definitely augurs well. We'll have to look at the details though. And therefore, from an FY27 perspective, there could be an upside to the GDP numbers that we are looking at right now. Again, it sort of depends on the details that we get. And from a global perspective, also, if you see, growth has been holding up quite well. So be it in the US, if you look at, data like the PMIs, and we see probably a bit of that in the industrial metal prices also, although very early days. But even otherwise in the US, growth has been buoyant, not just because of AI, but also because of fiscal and so on. So the global scenario has also been quite to the upside. So that sense, if we get a good deal in terms of the details, that should definitely augur well. And with the rupee again, possibly we've had good news, and therefore the rupee has recovered a bit. But then we also have to look at how our non-oil, non-gold imports are going to be going ahead. If that has actually sort of inched up a little bit, if what trajectory that takes would also decide the rupee, apart from the capital flows and RBI FX intervention.
Right. Basant, let me come to you. Closing comments. What's the sense like with regard to the 10-year bond yield? Should it start to gradually taper downwards? Do you expect it to continue to be at the rate at which it is? What's the take there?
So overall, the spreads as against historical repo rate versus 10-year benchmark is extremely attractive. So on an average, last 10-year historical median spreads are close to 105 basis points. And currently we are trading in the range of say 140 basis points or so. So the scope still remains. It really depends on how the state loan supply evolves over the next year. But I think we will be trading in a narrow range of say between in the immediate term, perhaps closer to 460, 660 to 675. But perhaps once you start seeing the longer end demand kicking in, you should start seeing yields moving downwards from here. The only thing is that over the last year, we've seen significant amount of flows being redirected by long only funds towards equity. I think that space, because of the regulatory changes, have been significantly consumed. And going forward, with incremental flows kicking in, you should start seeing those flows move into the SLR segment, and that should sort of drive yields downward.
Okay, so that's the outlook going ahead. The bond yield is expected to come lower, but yes, on that note, we'll wrap up this very special coverage of the RBI MPC policy. Thanking all our guests and panelists for joining us, Mr. Rama Mohan Rao, Shrijit Balasubramanian, Ms. Anubhuti Sahai, Mr. Basant Bafna, as well as Mr. Sunil Mehta. But shifting focus and bringing